G'day folks, and welcome to a Check on Chain update for the 1st of May. Now, some of you may be waking up to some fairly red candles, and today's video is probably aptly titled Bitcoin Bull Market Blues, because we have actually decisively sold off below the short-term holder cost basis. And this is something that we've been talking about for a couple of weeks now, and pretty much since we launched, about this concept of a market being top heavy. And that short-term holder cost basis was a key level, about 59,500. That was a key level that Check on Chain subscribers were paying attention to, because really that is the level we move into this top heavy market to explore this in a bit more detail, but also add in a bit of flavor in terms of derivative markets and what else is going on. So just before we do get started, just as a quick reminder, this is part one of our series, part one of our video. Check on Chain subscribers will get access to both parts. What we're going to do today is cover the first two sections here, the role of ETF demand and leverage and derivatives in the role of this sell-off. And then as we move forward, we're going to go into the on-chain side of the equation, look at what I mean when I talk about top heavy. And in particular, this chart on the right-hand side here, we actually just rolled these out on Check on Chain. These are some really, really powerful signals for looking for that flip in momentum when people really start to panic. So what we are going to be doing today is exploring this idea of breaking below the short-term holder cost basis. What were the mechanisms and the demand vectors that got us here? How do we end up breaking below this level and losing the bottom of this consolidation range? And really, what are the things to be paying attention to moving forward? So as always, please do give us a like, a share, and a subscribe. If you do enjoy this content, please let me know what you do enjoy in the channel below. The comment section, we read through all of them, whether it's on Substack, whether it's on YouTube. We really appreciate your feedback. We're always looking to improve and grow. And without further ado, let's get stuck right into the analysis. Okay, so the correct place to start here is actually to start by looking at ETFs and their flows. So what I've got shown here is the ETF flows in USD. Now, the reason why I want to explore this, and we'll talk about this in just a second, whilst ETFs aren't the largest part of the market, they were a very significant one. And you'll often hear, if you spend some time with, when I'm looking at on-chain data, what you'll tend to hear me say is that on-chain data is a significant subset of the market. And quite often the sentiment and the demand and the supply vectors that we see on futures or in the on-chain space, or in this case in ETFs, you'll find more often than not are actually synonymous across all of them. When you see weakness in the ETF market, thus far, we're also seeing weakness in the on-chain market, and we're also seeing weakness in the futures market. You tend to see these things, it's just a collection of people and traders and investors, and yes, they may be using a different instrument, but their behavior patterns are remarkably similar. So what are we seeing in the ETF space? Well, first things first, GBTC just simply continues to be just persistent. Let's only put GBTC on. It's just persistent sell side. 93 million was yesterday. Last week, we got 82 and then 130. GBTC is just this continuous overhang. Now, unfortunately, this week, let's bring everything else back. Let's turn off GBTC. We've actually got net flows coming out from some of the others as well. In fact, FBTC, which is the second largest, has also seen a bit of an outflow. This week, 213. It's only been 2 days in. Last week, we had 330 million. So these are not small numbers, right? We are seeing a little bit of weakness. We will see how this plays out over time. But overall, net sell side is obviously net sell side. It doesn't matter whether it's GBTC, whether it's FBTC, or it's coming from long-term holders. Now, granted, long-term holders are slowing their spending, but if the ETFs are synonymous as some subset of the market, we can probably expect there's going to be that sell side happening elsewhere as well. Now, on the subject of GBTC, as grim and dire as it may be, they still have 300,000 Bitcoin sitting in there. Now, as I've said a couple of times, my general instinct with GBTC is that they are going to be one of the preferred mechanisms for sell side this cycle. Anybody who owns GBTC and something else, right? Whether it's another ETF, whether it's spot Bitcoin, whatever it is, my instinct tells me that they're more likely to sell the GBTC because it has the highest fee and it's probably put them through a bit of a challenging time when they've held it. So as a result, I would expect GBTC outflows to continue. They have slowed relative to where they were when we first started this whole ETF journey. Nevertheless, as we saw in that previous chart, they continue to drip those coins into the market. And, that is just going to be an overhead resistance we have to get through. And in many ways, right, we've had our halving, but we've still got to chew through the supply that's coming out of GBTC. This is just the nature of the beast. And, in many ways, GBTC is much bigger than the cut in issuance has been thus far. Okay, so sticking with spot markets, because obviously now there's actually two insights I want to pull out of this chart. Some of you may be familiar with the cumulative volume delta. Some of you, this may be a new concept, so let me explain what this is. When you're in a trade, when you're on an exchange, you may have noticed there's a couple of different order types. There's market buy or market sell, where you're just hitting the bid or hitting the ask. That's a degree of urgency, right? Somebody doesn't care what price they get filled in. They're just saying, fill my market order at whatever the nearest price is. That is the market side of the equation. That is what CVD is measuring. All of the market buys, subtracting all of the market sells, what is left over at the end of the day across all spot exchanges. So green levels is basically showing you when more people were hitting market buy and on more volume, it's telling you the amount of excess market buy volume. Now, what we can see is really there's three, actually, I should say two, we should probably say three insights here. The first one, I want to take you back to 2022. This is the FTX bottom, right? Back in Bitcoin was dead for a decade. It actually makes sense. There's a lot of market selling because we were literally trading lower for a long time. So this is bear market things. We got a bit of market sell side down through here, but notice that we actually got maximum sell side on this dip before we actually started moving higher. Now, here's the one that I really want to highlight. If you've been following this channel, you've seen the drawdown chart that I refer to all the time, where it looks at each cycle and it's got all the different drawdowns by time. Well, something that was puzzling me for a long time before I found this piece of data is we got so few 20% corrections, and yet the market was just grinding sideways. I thought there must be someone underneath us accumulating and acquiring those coins. Here they are. There was somebody underneath, somebody, probably many people, right? Many entities, whether they're hodlers, institutions, doesn't really matter who it was. Mr. Market was sitting underneath the price and just accepting market sell orders because there was so much market sell activity. Someone or something or many folks were just absorbing that sell side, just allowing it to come to them, patient buyers, just allowing the market to fill their bids. Now, that obviously flipped in 2024, right? As we came into this year, the ETFs go live and everything went max bid. Suddenly, everybody's hitting the market buy order. And isn't it funny that we actually peaked right into the 73K peak and we've now pulled back? Now, as we get towards the bottom end of this range, and we've actually broken down from this point since this chart was rendered, we've actually had a flip back into market sell side. Now, this is, you could argue, could potentially be somewhat of a miniature capitulation. We'll explore this in a bit more detail in later charts. But this is the first sign that we've actually gone from net buy side into net sell side. You could consider that to be a contrarian signal. We could also, we have to investigate further, but we could also see this as a bit of a flipping in market sentiment, right? Particularly upon breaking the short-term cost basis. Now let's have a look at derivatives, because derivatives, if I just take you back to if you were there for it, well done, because it was a really hard day. Back here in May 2021, this sell-off was particularly horrific. March 2020 was bad. This was also pretty nasty. This was like 50% down. It traded from 55 or something down to 29,000 in just a day. Now, very similar to that signal I was talking about before, that kind of capitulation type signal, very big flush outs in terms of funding rates, right? So funding rates go very, very negative, which means people are just being market sold. They're getting margin called, flushed out of their positions. So these very deep negative wicks on funding rates, generally speaking, are some kind of a capitulation, derivative washout, something of that nature. Now, we definitely had the excess euphoria on the way higher, right? As these ETFs went live, we got a major excess in the amount of essentially the interest rate that people were paying in funding rates. But notice how this really declined quite orderly, actually. We didn't get any kind of major capitulation wick. In many ways, it was actually quite an orderly decline for the most part. This doesn't feel like it's derivative-led. And even where we currently are, this doesn't feel like we've had any kind of major derivative-led washout. But we have to explore this just another layer. Let's have a look at it in terms of the open interest side of the equation. So again, here we are trading lower, getting down to the bottom of the range. We can see that our open interest here in orange, this is priced in BTC. Now, the reason that I look at open interest in BTC is it helps me look for deleveraging events and the general trend. Are we seeing leverage growth or leverage reduction? If someone opens a 1 BTC position, then it's the open interest is going to move with the coin price. So when you do get a big move, is it because the coin price went down, or is it because people got flushed out of their position? Looking at it in BTC terms helps filter out at least the coin price side of the equation, so we can see periods of growth and decline in net leverage. So the big takeaway, a lot of this big mountain here is FTX. So if you kind of just pretend that little mountain is there, let's just smooth right across. Notice how leverage is actually on a downtrend. We've got a net reduction in leverage in the system, which is actually a good sign. So it's not overly excessive as it stands today. In fact, it's at the bottom level of where we usually had the bottom of deleveragings in 2021. Now, there's another really important factor. Let me just turn off that open interest. And that is the proportion of those contracts which are coin margined. Now, some of you may know what that means, but if you've got a futures position, you need some kind of collateral, the asset that you've opened it up, right? So it's kind of your backing of your position. Now, up here, very high values, 80 odd percent. Back here in 2021, this nasty looking sell-off was because 80% of all futures contracts had BTC or some other crypto asset as their margin. Now, when the price goes down, if you're long, your futures position goes down, but so does the asset that you're backing that futures position with. So you get double. It's like a convex side to the downside, and people got wiped out. We never even got remotely close to these levels again. It's been essentially a widespread long-term deleveraging of the market ever since. So here we are down here at 40%, 30%. This is essentially telling us that the futures market is much, much healthier. We don't have that kind of reflexivity still baked in. This is a good sign. It is an important thing, but we're building up a picture here that maybe derivatives weren't a major factor in this particular sell-off. And given we started with the ETFs as a bit of a spot-driven sell side, much like the uptrend has been very spot-driven, in my opinion, it feels like this downtrend is also very spot-driven. And these are all starting to build up a bit of a picture of what we can expect moving forwards. To really kind of hammer that point home, this funky looking oscillator is essentially open interest, but it's looking at it on a 7-day change, right? How much does open interest change over the course of 7 days? And I've got some very simple statistical levels here, plus or minus 2 standard deviations. Notice that +1, these red dots, tend to happen when the market's getting pretty hot, pretty toasty, moving hard, moving fast. People are adding leverage, feeling like the world can't, Bitcoin has no ceiling. It's up only forever. These are generally points where you go, oh, it's starting to get a bit hairy up here. And of course, we got one of those as we came into the peak, but it works to the downside as well. Notice these blue zones on the bottom of these bear market zones, on the bottom of that sell-off we looked at before, the August sell-off, which we covered quite a bit back in the day, and then twice during this particular event. These are deleveraging events. Now, we haven't seen that flag during this particular sell-off. We've seen a deleveraging elsewhere, but we haven't seen a kind of major washout. So overall, it actually feels like this isn't a derivative-led sell-off. It feels like a lot of the activity that's going on right now, it seems to be more spot-driven. Therefore, this is why the on-chain side is really, really important, because ultimately this is a spot-driven market. And on-chain is just absolutely fantastic for understanding what's going on in the spot space. Now, the very last thing I want to touch on with our derivatives assessment is just one thing to pay attention to moving forward, and that is how many people are now going levered long. Now, what we saw with funding rates is it's not overly high. We're not seeing a very positive funding rate. So that's telling us that right now people aren't kind of market hitting. They don't want to be long and high degrees of leverage. But bear with me for a second. As we rallied, right, from 38K after the ETFs went live, all the way up to 73, notice that this whole period was actually short liquidation dominance. Shorts were getting squeezed. They were betting against this rally the whole way up. Now remember, markets are always about being some degree of a contrarian. You want to look at what the crowd is doing. Generally, the crowd isn't right. That's kind of just a market adage that goes on for years and years, right? Generally speaking, when everyone's doing the same thing, it's probably not the best idea. Everyone was shorting all the way up, and of course, it was a bad idea. Now, people continued to short. We got some pretty nasty sell-offs, short, and now people are going long as the market trades lower. You could have short any of these particular sell-offs, but instead they decided to go long, and now longs are the ones getting liquidated. So isn't it interesting that people, just generally speaking, aren't great traders because we get to see it play out in the data. We get to see that they short it all the way up when they were finally convinced, okay, right, that's it. Now I have to be long, right? They got wiped out on the short side. They finally decided, okay, today's the day I'm going levered long because we're going to 100K, and we went to 57. Right, this is kind of the nature of markets. They are cruel, and in many ways, it's a tough slog, right, to make it. It's not an easy job. So that wraps up part one. We are now going to jump across to part two and spend a bit more time understanding why we broke through the short-term hold cost basis, what it means, have we transitioned into a top-heavy market, and really what are some of the signals that we're seeing in the on-chain space that could signal there may be some rumblings moving ahead. So thanks, folks, for tuning in for part one of our weekly analysis. If you enjoyed the video and you want access to the full video and the rest of our analysis, do head over to our Substack and hit subscribe. As a paying member, you'll actually get access to a second piece of analysis each week, as well as the comment section where you can ask me questions and we'll answer them in a Q&A on a regular basis. So thank you so much for all of your support. We hope you enjoyed it, and we'll see you in the next one. Cheers.